The yield on the US 10-year is inching lower as bond and stock prices move higher thanks to the so-called Powell pivot. With the Fed now on pause in terms of further hikes, investors seem happy to buy both markets. But can it continue? All eyes will be on the FOMC's latest meeting minutes tonight for clues into US monetary policy. Serge Berger joins me now from Zurich from thesteadytrader.com. Serge, thanks for joining us. Now, I mentioned equities and bonds there. I know you've been looking closely at the yield on the 10-year, but what does it mean for the US dollar?
Hey, Victoria, it's good to be on. You know, I think what a lot of people are looking at right now is as you call it, the Powell pivot, and ultimately once people realize why the Fed is on pause, things will probably change a little bit. But I look at the US dollar, and we can look at the very simple chart here. Just have, for example, that red line is your 200-day moving average. Just through the lens of technical analysis, I just don't see this rolling over just yet. In fact, if you realize that we have almost no yield, Europe is basically going back, Italy's in a recession, European data has been slowing for 12 months. U.S. data is starting to really slow down, and ultimately, I think investors are going to continue to put money into bonds. At this point, yield is kind of scarce to come around unless you want to take on a lot of risk. So 2-year U.S. yields at 2.5%, 10 years closer to 2.7, 2.8 is probably a fairly attractive point, particularly if you consider that baby boomers are more and more retiring. You know, and so all of that I think will continue to put pressure on yields and probably put upward pressure in the U.S. dollar, really from a structural perspective, at least for the foreseeable future of a few months, maybe a few quarters.
What about the stock market? Because it's been a very strong start to 2019 for US large cap stocks. A massive change from where we were at in the fourth quarter of 2018 when we saw some heavy losses. I know you've been taking a look at the chart of Amazon. Do you think that the price looks overextended where we are now?
Yeah, I think for the most part, U.S. equities are now in panic buying mode. A lot of the fund managers and hedge funds and larger family offices and those kind of clients that I speak to on a daily basis are basically very weary of what's going on. At the same time, they're forced to chase performance. So I look at something like Amazon, and I see a couple of things. First of all, we had a big mean reversion move, of course, late last year into December lows, but right now we're just kind of ricocheting back to a spot here. Again, you can look at that very simple red line, and I don't want to oversimplify things by just looking at a moving average, but in this case, it does actually look interesting. So there's a very simple 200-day moving average. You can draw some Fibonacci numbers, and you can draw 1,000 other things probably, but it's all kind of coming together at the same spot here. More importantly, if I get rid of these funny colors here for a second, if I could, then what you'll see is that the way that the company, specifically Amazon and others, traded after earnings. So the company reported earnings in late January, and I'm going to zoom in a little bit closer. And if I'm not mistaken, this right here is where the stock basically bounced into maybe just before earnings or after, and then basically it's been lower ever since. So a lot of hope on earnings, moving into or rallying into a lot of technical resistance, and since then basically backing off. Now, I'm not saying Amazon has to retest these lows, but I think upside here is very capped, which probably juxtapose that to the broader market means the broader market is probably running on fumes here, at least for the time being.
So does that kind of pattern translate into some other stocks within the sector as well? Is that a pattern that we're seeing across the board, or is that specifically to Amazon? I know you've been taking a look at the chart of Alphabet, so perhaps we could have a look there and see what's going on, see whether that stock has peaked as well.
Yeah, it's the same scenario. Here we can draw a bit of a longer-term chart to give you a little perspective, and you can see what used to be support using this very simple green line may now be resistance, and then you zoom in a little bit closer and you see that all these moving averages, even though we've pierced above them, remember this is all a bit more of an art than a science, you know, it's still all there. Now Google, or Alphabet as you call it, had earnings in early February. The stock, again, just like Amazon, basically rallied into earnings, but then very quickly kind of gave it up. So again, I'm not saying the stock has to fall apart from here, but I think the upside here is very limited. And again, I think the sort of reverberations of the broader market will be that the upside, the broader market too, in addition to all the economic slowdown data, will probably be capped here for the time being.
So do you think that extends into the major averages stateside as well?
Yeah, absolutely. I mean, we can look at something like the Nasdaq 100, which is more related to those two stocks that we just talked about, or you look at like the S&P 500, which I can quickly bring up here. And it's the same idea. I mean, you know, technically speaking, we're basically just revisiting what used to be support, may now be resistance. Now, again, we're going to overshoot, and we have been overshooting for a week or two, just like we overshot on the downside in December, right? So a lot of the stuff that I'm seeing out there is literally panic buying. Some of the machines are kind of just playing on algorithms. Remember, most of the machines out there, you know, 89% of trading is now machines, and the most thing they look at is momentum. And if that continues to work to the upside, they will continue to squeeze it higher. But really, structurally speaking, things aren't looking very good, and I think we're probably going to be tapped here very soon.
Serge, thanks so much for your time.
Thank you.
That was Serge Berger from thesteadytrader.com. I'm Victoria Scholar, and remember to find me on Twitter. I'm at VictoriaS_IG. See you soon.